Bristol Myers just reported their earnings. They are at a 52-week low. They offer a yield just below 5% and have been down 31% over the last year. Is this the most undervalued company on the market? Is it a strong buy? Let's find out. We're going to take a look at the historical performance of the company. We'll look at their top line revenue growth, bottom line net income growth year on year, as well as their latest year, 2023. We'll look at the health of this company, total cash versus total debt. We'll analyze whether or not they have been performing well versus their competitors over the last 5 years. We'll discuss a lot of insider buying by CEOs and directors over the more recent period. And we'll see from quarter to quarter whether institutions are also buying this company. We'll take a look at their dividend safety. We'll run through some of their financial metrics. And we will touch upon their essential earnings that they did report just a few hours ago. And don't forget, we will run them through the valuation model to get to the intrinsic value as well as the acceptable buy price given that investor margin of safety, and see what Wall Street are forecasting for BMY over the next 12 months. So let's take a look firstly at their earnings that they did just release. So we can see Bristol Myers Squibb results top estimates as their new drugs post strong sales growth, which is great to hear. Some of the key points, while BMY reported their quarterly earnings and revenue that topped expectations, as its portfolio of new drugs posted strong sales growth. So that is nice to see. Always good to see a beat as well as the new drugs from this company performing very strongly. And we also see they did give a full year revenue forecast in line with expectations. But what they did do was anticipate earnings that they will see as higher than what Wall Street are forecasting over the next year. In terms of the numbers then, for those that like to see the specifics, $1.70 adjusted on the earnings per share, a very strong beat versus 153 expectations, 11.48 in terms of the revenue, and 11.19 which was expected. So that is very positive to see. Always good when they do beat the expectations, and we can see this quarter versus the previous quarter in 2022, they are up around 1%. So it is positive to see from a company that has had a very troubled time over the last year, and we can see it has plummeted down 31% over the last year. Over the last 10 years, you would be down 3% on your investment. Now, bear in mind, all-time high does sit at around just over $80, $81.13, which we see in November 2022. But also bear in mind, down 3% doesn't include those dividends reinvested. So it is at the 52-week low and a very strong yield, just under 5%. So what we typically like to see on the top line revenue is 3 to 7% growth year on year. $22.6 billion in 2018, $46 billion in 2022, 2023 a little bit of a drop down to $45 billion. So yes, they have been increasing over the last 5 years, and in fact it is expected to drop in 2023. Nonetheless, strong growth whilst it isn't consistent, as we can see here. In fact, 2021, 2022 flat, 2023 a little drop. It is still significantly higher than 5 years ago. Bottom line, similar story, $5 billion reported in 2018, $6 billion in 2022, 2023, $8.3 billion. So again, very nice to see that whilst it has grown over the last 5 to 6 years, there are still inconsistencies to note. So overall, not too bad for BMY, just something to keep an eye on. Whilst it does increase over a longer time horizon, year on year, there isn't a lot of consistency with their growth. Quick health check of the company, total cash versus total debt. 8.8 billion cash short-term investments in 2018, 7.7 billion in their latest report. So it has dropped very slightly, not massively, and what is important to note, the movement directionally and numerically for their total debt. 7.4 billion in 2018, a staggering increase to 39 billion in their latest quarterly report. So let's touch upon some debt metrics when we analyze this later. In terms of how they've performed, well, we can very quickly look at some others in the pharmaceuticals industry. We have GSK, Merck, as well as a few well-known others. Now, over the last year, if we include those dividends reinvested for the total return, they are down negative 28%, and we do see them as the worst performing in their industry versus their peers. Last 5 years, they are up 14%. The second worst, not really great. You don't want to see a 14% increase over a 5-year period. The only positive spin to say here is that past performance isn't an indicator for future performance. Now, what we love to see is insider buying, especially when we see the CEO buy. And the reason for this is typically insiders buying is a huge bullish signal because they buy, as always, because they see the share price going up over the next few years. So we can see they did buy very recently in November, at the end, in fact, and the beginning of December, up to essentially 100 grand from himself in December, 150 grand at the end of November, with a director buying 423 grand as well. So lots of positives. And do bear in mind though that even the price they bought at, the share price has come down. So you could, if you bought now, you'd be buying at a lower price than these insiders. In terms of institutional ownership, well, 75% as we can see, around 10 billion worth of sales by these institutions over the last 12 months. The same period, a lot more buying, 54 billion. Huge buy in Q2 of 2023. Q3, a bit more selling than buying. Q4, pretty much roughly the same with a little bit more selling. Overall, though, we see insider buying and institutional buys for the large part over the last 12 months. Dividend safety score 70, it is safe. Market cap 99 billion. We are talking about a large cap company. Now, some key recessionary metrics. Well, they maintained the dividend in the last recession, below average growth, but did significantly outperform the S&P, negative 32% versus the S&P's negative 55%. Dividend growth, not the worst, 5.3% in December, so just a few weeks ago. It is above that minimum 4% inflation that we talk about on the channel. Plus, you are getting a starting yield of around 5%. Over the last 5 years, 7% is very nice to see. Last 20 years, not that great. It is essentially below inflation. In terms of their dividend growth streak, well, they have been increasing those dividends for the last 16 years. Now, when we focus on dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. 4.9 versus 3.15, a significant undervaluation signal. In fact, one of the highest yields offered over the last 5 years. Forward PE, again, undervaluation signal, 7 versus the 5-year average of 9.1. And we see it significantly lower than the healthcare sector PE at 17.6. Now, when we analyse the free cash flow payout, as we always do, because the earnings is susceptible to manipulation by management through accounting, we do see the last 6 to 7 years around that 60% or lower. 2023 at 42% is very positive, as I personally like to see it below 60% to really offer those nice double-digit increases we love to see. Free cash flow per share, it has been increasing, 183 to 561. Granted, it isn't consistent, but it is difficult to find a lot of companies that have consistent growth to the free cash flow. 2023 expected to be roughly in line with the previous year. 2024 expected to be some strong growth, which is great to hear for investors and potential investors. Sales growth, remember, 3 to 7% for steady moderate growth. Now, the last 2 years, fairly poor, flat in 2022, negative 4% in 2023. We would like to see it go back to that period where they did have some strong growth. So something just to bear in mind when we do look at their forward guidance. Total sales, though, has increased 16 billion to 46 over the period. Shares outstanding, important to understand. They have diluted your position over the years as a shareholder. They have issued shares. So just something to consider. Unfortunately, they haven't done any share buybacks. And even if they have over the period, it has taken away from the net dilution that we see. So in terms of the ROIC, 10% or more is my personal favorite. It means management are able to effectively allocate their capital. A lot of people bring this up to above 25% for biotechs. Over the last 3 years, above 10% for me personally, I am satisfied with that. But again, you could keep an eye on that given how low it has been over the last few years. Margins, very inconsistent. It isn't really what I want to be seeing from a company I'm investing in. But again, something just to keep an eye on. It is pretty much below 25% for the last majority of the 10 years. And whereas the free cash flow margin does paint a little bit of a rosier picture, 20% in 2017, which has increased, although we do see it stabilize over the last 2 years in the mid-20s. Net debt to EBITDA, now this is very important, earnings before interest, tax, depreciation, amortization, because in effect it shows us the strength of the balance sheet as well as the dividend safety, and these represent the number of years it would take the company to pay off all of their debt net of cash on hand. 1.55 in 2022, 1.72 in 2023, a little bit too high for my liking, but just something to keep an eye on. Hopefully it does come back down and we don't see it go up to that very high level of 2019. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now, when we jump into the first model, we have Graham's valuation, where we have the stock ticker symbol, the earnings per share, long-term growth rate, corporate bond yield for AAA. We see an intrinsic value of $72. Now, market value of $49, we have our first sign of undervaluation. Do bear in mind, though, we don't look at any of these models in isolation, and we will conclude towards the end. We then have the multiple valuation model with the average PE of companies in a similar sector and size, multiplied by that of the earnings per share of BMY, to get an intrinsic value showing some severe undervaluation right now, as we can see here. We then move on to the third model, the dividend discount model. Now, nice growth on average, 8%. Now, we have gone very essentially conservative, given that we have gone lower than the average as well as the low of the last 2 years. This gives an intrinsic value showing, again, severe signs of undervaluation. We then move on to the fourth and final model, where we have the free cash flow year on year. Average growth rate, 27.5%. Again, we've gone more conservative than analyst estimates at essentially flat. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as we can see here, a huge sign of undervaluation. So then the intrinsic value for today's episode for BMY is the average of these four models, which arrives at $73. Don't forget, you can click on the pinned comment below if you want to grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. As always, we start off with a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. We keep going until it comes to roughly the current trading price, and we can see this is a heavily margin of safety stock. Up to around nearly 35% is around $1 shy. So around that $48 mark, we see around a 35% margin of safety based on our estimates and judgments. In terms of Wall Street and what they forecast, well, over the next 12 months, they have a price target of $62. They see upside of 28%, so they do believe Bristol Myers Squibb is a very strong buy. As always, though, do let me know your thoughts in the comments below. Is this one that you do believe is a strong buy? Have you been adding? Or maybe you are bearish for certain reasons. As always, have a great day. If you enjoyed today's episode, smash the like button, hit that subscribe so you are continually notified of these videos as they drop. And as always, have a good one.